For most of modern history, people have believed the same comforting lie, that the system they live inside is stable, that the rules won't change, that savings are safe, jobs are secure, and tomorrow will look roughly like today. Every major financial collapse began with that belief. 1929 didn't feel dangerous in 1928. The 1970 seconds didn't feel like a reset in 1969. 2008 didn't look inevitable in 2006. And COVID didn't feel possible in January of 2020. Right up until the moment it was. Here's the part most people miss. Crises don't arrive as shocks. They arrive as confirmations. They confirm what was already mathematically broken and expose who was standing in the wrong place when the ground gave way. History doesn't punish people randomly. It punishes positions. Across the last century, through the Great Depression, inflationary resets, financial collapses, and global shutdowns, most people lost wealth not because they were reckless or ignorant or unlucky, but because they trusted the wrong form of safety. They trusted cash. They trusted wages. They trusted pensions. They trusted promises. And every time, those promises broke before the system did. What's unsettling isn't that crises keep happening, it's that they keep happening the same way. The same transfer. The same winners. The same silent losers who only realize what happened after the numbers stop making sense. This video is not about predicting the next collapse. It's about understanding why, when everything breaks, only a few positions survive, and why those positions haven't changed since 1929. Because once you see the pattern, you stop asking when the next crisis will come. You start asking a more dangerous question. What if the safest place you believe in is the most dangerous one? If you strip away the headlines, the slogans, and the panic, the last 100 years start to look less like chaos and more like a controlled experiment. Différents dégâts, different villains, différentes excuses. But the outcome barely changes. Since 1929, the world has lived through 4 major economic resets that were supposed to be once in a lifetime. The Great Depression, the inflationary collapse of the 1970 seconds, the financial crisis of 2008, and the global shutdown during COVID. Each one arrived with a different story. Each one blamed a different cause. Each one promised a different fix. And yet, when the dust settled, the same groups walked away intact while everyone else started over poorer than before. That's the first uncomfortable truth. History doesn't reward effort equally during crises. It doesn't protect loyalty. It doesn't care how long you waited, how hard you worked, or how responsibly you played by the rules. Across a full century of breakdowns, only 3 positions consistently preserved and often increased wealth. Not strategies, not tricks, not clever timing. Positions where you were standing when the system rebalanced mattered more than what you believed, voted for, or hoped would happen next. This is why looking at any single crisis in isolation is misleading. You can always explain one collapse away. A bad policy, a corrupt banker, a virus, a war, a mistake. But when the same result repeats across different systems, currencies, and generations, coincidence disappears. What you're about to see isn't a theory. It's a pattern that's already been stress-tested 4 times with real people, real losses, and permanent consequences. History already ran the test. Most people failed it. Most people believe they lose money in crises because something went wrong. A bad decision, a bad government, bad timing. That belief is comforting because it implies that next time, things could be different. But history tells a colder story. The average person is not accidentally exposed during a crisis. They are positioned to absorb the damage. Long before the collapse makes headlines, their wealth is already parked in places designed to be sacrificed. Savings accounts, wages, pensions, assurance promise, fixed incomes, all of them share the same weakness. They depend on the system remaining solvent, liquid, and honest at the same time. Crises break at least one of those conditions, usually all 3. When liquidity dries up, wages stall. When debt explodes, pensions get restructured. When governments panic, money is created, and savers pay the price. This is why losses during crises feel personal but aren't personal at all. They're structural. The system can't fail openly, so it fails quietly by draining the least protected positions first. Here's the rule most people never hear. Wealth doesn't disappear in a crisis. It moves. Every dollar lost by a saver shows up on someone else's balance sheet as a gain. Every pension cut strengthens another institution's survival. Every diluted paycheck preserves someone else's asset. Crises are not storms. They are transfers. And the direction of that transfer is consistent. From cash to assets. From wages to ownership. From patience to positioning. The tragedy isn't that people didn't see it coming. It's that they were taught to stand exactly where the impact would be strongest and told that standing still was responsible. So, before we look at who survived, there's one question you have to answer. If wealth never disappears, where does it go? When people talk about 1929, they talk about a stock market crash. That framing is convenient and completely wrong. The Great Depression wasn't a market failure. It was a collapse of debt and liquidity, a moment when the promises holding the system together stopped being believable. Stocks fell after confidence broke, banks failed after liquidity vanished, jobs disappeared after credit froze. Before the crash, America looked prosperous. Credit was easy, speculation was normal, debt was everywhere, quietly stacked beneath the surface. People borrowed to buy stocks, businesses borrowed to expand. Banks lent against assets whose prices only made sense if growth never stopped. Then, the system asked a simple question: can the debt be repaid? The answer was no. When that realization spread, cash stopped moving. Banks didn't lend. Businesses couldn't roll debt. Employers couldn't meet payroll. The economy didn't slow, it seized. And here's the part most history books rush past. The first people wiped out weren't reckless speculators. They were ordinary workers, savers, and cash holders. People who had done exactly what they were told. Savings vanished when banks failed. Wages vanished when businesses collapsed. Cash became scarce, then useless, then inaccessible. Money didn't protect them. It trapped them. The government responded by shutting banks, redefining money, and rewriting contracts. Gold was confiscated. The dollar was devalued. What people thought they owned turned out to be conditional. This wasn't punishment. It was necessity. The system couldn't survive while honoring every promise, so it broke the weakest ones first. That's the real lesson of 1929. The market didn't fail first. People did because they were standing in positions that depended entirely on stability. And once stability disappears, safety becomes an illusion. The market didn't fail first. People did. After the dust settled, after the banks closed and reopened, after the dollar was redefined and the rules rewritten, a strange thing became clear. Not everyone was ruined. Some people didn't just survive the Great Depression. They emerged with more control, more leverage, and more opportunity than they had before. And it wasn't because they predicted the crash. It wasn't because they were geniuses. It was because of where they stood when everything froze. Farmers who owned productive land still ate. Business owners who controlled essential goods still sold. Landlords with real property still collected something even if the currency changed. Their wealth didn't vanish because it wasn't dependent on paper promises. It was tied to things people needed regardless of the system's condition. Meanwhile, the responsible positions collapsed. The saver with cash in the bank had nothing when the bank closed. The worker with a steady job had no leverage when employers failed. The retiree with fixed payments watched purchasing power dissolve. The Depression didn't reward effort or morality. It rewarded utility and control. Those who owned assets that produced value, food, shelter, energy, services, didn't escape pain, but they escaped annihilation. Their position gave them optionality. They could wait. They could negotiate. They could adapt. That distinction matters. Because history didn't select survivors based on intelligence or virtue. It selected them based on structure. Who controlled something real? Who depended on someone else's promise? Who could endure when money itself became uncertain? The Great Depression wasn't a lesson about markets. It was a lesson about positioning. And once you see who survived the first great collapse of the modern era, a more unsettling realization follows. Survival wasn't about being smart. It was about where you stood. There's a simple way to understand why some people survive when systems break. They own things that still matter when money doesn't. Productive assets aren't abstract. They're not numbers on a screen or promises written into contracts. They're things that do something. They feed people. They house people. They move goods. They generate value even when the rules change. Land that grows food doesn't stop being useful because a currency is devalued. A business that provides an essential service doesn't disappear because a bank fails. A resource people need today will still be needed tomorrow, no matter what it's priced in. That's why owners of real, productive assets keep resurfacing after every crisis. When cash becomes scarce, assets become bargaining power. When wages collapse, assets become income. When currencies are redefined, assets get repriced, not erased. During the Great Depression, farms didn't vanish. Factories didn't vanish. Housing didn't vanish. Ownership survived even as paper wealth burned. And this is where many people misunderstand risk. They think assets are dangerous because their prices fluctuate. But price volatility is not the same as existential risk. Cash has no volatility and no defense. A savings account doesn't fluctuate. It just quietly loses relevance when the system needs to reset. Productive assets fluctuate, but they persist. They bend with inflation. They adapt to new rules. They survive devaluation because they are not the thing being devalued. This is why every reset quietly transfers wealth toward ownership. Not because the system is cruel, but because it has no alternative. People still need food, shelter, energy, and services even when money fails. When money dies, only usefulness survives. And that raises a dangerous question. If ownership protects you when currencies break, What happens during a crisis that doesn't look like a crash at all? The second reset didn't arrive with panic. There were no bank runs, no mass unemployment overnight, no dramatic market collapse that forced people to look up. That's why most people missed it. The 1,970 seconds didn't destroy wealth loudly. It dissolved it quietly. Prices rose slowly at first, then faster. Wages increased, but never enough. Savings accounts still showed the same numbers, they just bought less every year. Nothing looked broken. But everything was changing. Inflation did what crashes couldn't. It transferred wealth without headlines. If you held cash, you lost purchasing power every single year. If you lived on a fixed income, your lifestyle shrank invisibly. If you saved patiently, your reward was erosion. Meanwhile, something else was happening beneath the surface. Debts were shrinking in real terms. Assets were repricing upward. Owners weren't panicking, they were adjusting. A mortgage taken out in the 1,960 seconds was being repaid with weaker dollars in the 1,970 seconds. Each payment felt lighter, not heavier. The house didn't change, the currency did. This is the cruel efficiency of inflation. It doesn't feel like a crisis while it's happening. It feels like inconvenience, like frustration, like confusion over why things cost more, even though nothing went wrong. But inflation is a reset without collapse. It allows governments to reduce debt without defaulting. It allows systems to survive without admitting failure. And it forces the cost onto the least protected positions. By the end of the decade, savers had lost decades of purchasing power. Pension holders were trapped. Workers ran harder just to stay in place. Yet, asset holders emerged stronger. The reset was complete, and most people didn't even realize it had happened. No crash, no sirens, just silent theft. And once you understand that, another uncomfortable idea takes shape. What if debt, the thing everyone fears, behaves very differently during inflation? Debt is usually framed as a weakness, a burden, a mistake, a chain around your future. And in the wrong phase of the cycle, that's true. But inflation flips the logic. When prices rise faster than interest rates, debt doesn't grow heavier. It shrinks, quietly, relentlessly. Every year, the real value of what you owe gets smaller, while the value of what you own gets larger. A fixed-rate mortgage is the simplest example. You borrow in strong dollars. You repay in weaker ones. Your payment stays the same on paper, but your income rises with inflation. What once felt tight becomes manageable. What felt manageable becomes trivial. Over time, the debt fades not because you worked harder, but because the currency did the work for you. This is why inflation is unforgiving to savers and generous to debtors. The saver watches purchasing power decay. The debtor watches obligations dissolve. During the 1,970 seconds, millions of households experienced this without realizing it. Homeowners who locked in fixed loans saw inflation do something remarkable. It transferred value from lenders to borrowers. Banks were repaid, technically, but they were repaid in dollars worth far less than the ones they had lent out. The debt didn't disappear. It was erased in real terms. This is why debt is not inherently dangerous. What matters is the structure and the timing. Variable debt during inflation is deadly. Fixed debt during inflation is leverage. And this is where most people get trapped. They avoid all debt because they're taught fear not context. They're warned about risk without being taught phases. They're told to be responsible in a system that survives by quietly rewarding the opposite position. So here's the uncomfortable truth. Debt is only dangerous in the wrong phase. And that brings us to the moment when the modern system finally broke in public. Not quietly, not slowly, but all at once. In 2008, the story everyone remembers is housing. Subprime mortgages, bad loans, greedy banks. That story is incomplete. The financial crisis wasn't a housing problem. Housing was just where the stress fracture showed first. What actually broke was leverage, a system built on borrowed money, stacked on borrowed money, all depending on prices never falling at the same time. Banks weren't lending money they had. They were lending money they expected to be able to replace. When that expectation failed, everything froze. This wasn't panic. It was recognition. Once lenders realized that balance sheets were insolvent, not illiquid, trust vanished. Overnight, institutions stopped believing in each other's numbers. And when trust disappears in a leveraged system, liquidity follows. The collapse should have wiped out the system. It didn't because governments intervened. But here's the critical detail that defines everything that followed. They didn't save people. They saved balance sheets. Banks were bailed out, markets were stabilized, interest rates were crushed, trillions were created to prevent asset prices from collapsing further. For households, it felt like rescue. For institutions, it was something else entirely. Losses were socialized. Gains were preserved. Homeowners lost equity. Workers lost jobs. Savers earned nothing for a decade. Meanwhile, asset prices recovered faster than wages ever could. This was the moment the rules quietly changed. From 2008 onward, the system made a choice. Protect assets at all costs, even if it meant sacrificing savers, distort prices, and punish anyone holding cash. The crisis didn't end capitalism. It rewired it. And once you understand who was protected in 2008, the next question becomes unavoidable. If the system saves assets, who does that leave behind? The years after 2008 were called a recovery. For most people, they didn't feel like one. Wages stagnated, savings earned nothing, living costs kept rising, but asset prices told a very different story. Stocks didn't just recover, they exploded. Real estate didn't just stabilize, it became unreachable. Capital didn't just survive, it consolidated. Those who already owned assets before the crisis were given something extraordinary. Time and cheap money, interest rates stayed near zero for years, debt was easy, liquidity was endless, asset prices floated higher, protected by policy. Meanwhile, those without assets were locked out. They were told to be patient, to wait for trickle-down growth, to save responsibly in accounts earning less than inflation. This is how wealth concentration accelerates. Not through conspiracy, through structure. If you owned assets in 2008, you were protected from downside and lifted on the upside. If you didn't, you were forced to play a game where the entry price rose faster than your ability to save. Recovery, for whom? That question explains the widening gap better than any statistic. The crisis didn't reset inequality, it hardened it. Which brings us to the third position, the one that looks dangerous until the moment it becomes decisive. Because when everything breaks, timing matters more than optimism. Liquidity has a reputation problem. For most of the cycle, holding cash looks foolish. It earns nothing. It falls behind inflation. It feels like hesitation disguised as caution. And most of the time, that criticism is right. But there is a narrow window in every crisis where liquidity stops being dead weight and becomes power. That window opens when forced selling begins. When leverage breaks, people don't sell because they want to. They sell because they have to. Margin calls, refinancing failures, job losses, missed payments. The same assets that looked safe weeks earlier suddenly need to be converted into cash immediately. And that's when prices disconnect from value. Not because the asset is worthless, because the seller has no choice. Liquidity in that moment isn't about fear, it's about control. The ability to wait while others can't. The ability to choose when to act instead of being forced to react. This is why cash is dangerous in calm periods, but decisive in collapses. In 1929, those with liquidity after the crash acquired land, factories, and businesses at fractions of their former prices. In 2008, funds with dry powder bought entire neighborhoods of foreclosed homes. During COVID, investors with access to liquidity stepped in, while panic froze everyone else. But here's the detail most people miss. Liquidity only works if it's temporary. Hold too much for too long, and inflation destroys it. Hold too little when the break comes, and opportunity passes you by. It's not a permanent position, it's a tactical one used briefly, precisely, and without emotion. Cash is useless while systems are stable, but when everything breaks, when selling is forced and fear is widespread, liquidity becomes the only thing that still obeys you. Cash is useless until everything breaks. COVID wasn't a new crisis. It was the same pattern, compressed. In a matter of weeks, the global economy did what usually takes years. Governments shut down production, demand collapsed, panic spread, and then, faster than ever before, the response arrived. Money, trillions were created almost overnight. Stimulus checks, emergency lending, corporate bailouts. Central banks stepped in as buyers of last resort for everything from government bonds to corporate debt. The stated goal was survival. The actual effect was acceleration. Assets didn't fall for long. They rebounded violently. Stocks hit new highs while unemployment was still in the millions. Real estate surged while wages lagged behind. Those who owned assets watched their net worth inflate in real time. Those who didn't were told to wait. Once again, the same three positions emerged intact. Owners of productive assets saw prices revalue upward almost immediately. Fixed debt holders watched inflation begin to eat away at what they owed. Those with liquidity at the moment of panic bought what others were forced to sell, and everyone else absorbed the cost. Savings lost purchasing power as inflation followed the printing. Workers returned to jobs that paid more nominally, but less in real terms. Late investors chased rising prices, mistaking recovery for opportunity. COVID didn't change the rules. It proved them. What once took a decade now took months. The transfer was faster. The response was larger. The consequences arrived sooner. The test repeated. The answers didn't change. And that forces a deeper question. If these same positions keep surviving regardless of the crisis, why do they work every single time? When you step back far enough, the pattern stops looking like finance. It starts looking like architecture. Every crisis rearranges the same three elements: who controls production, who controls the terms of debt, and who controls timing. Everything else is noise. Those who control production land, businesses, resources remain relevant no matter what the currency does. The system can change the unit of account, but it can't eliminate the need for food, shelter, energy, or services. Ownership of usefulness is permanent leverage. Those who control debt terms decide how time works in their favor. Fixed obligations during inflation are not burdens, they're dissolving contracts. The system inflates, but the debt doesn't. Value quietly moves from lender to borrower, enforced by policy and arithmetic, not morality. And those who control timing, through liquidity, aren't betting on direction. They're waiting for inevitability. Forced selling creates mispricing. Liquidity lets you step in without emotion, while everyone else is trapped by urgency. These aren't tricks. They're structural advantages. This is why trying to outsmart the market misses the point. Crises don't reward clever trades. They reward positions that align with how systems must survive. Governments can change laws. Central banks can change interest rates. Markets can change prices. But they can't escape math. Production must continue. Debt must be reduced. Liquidity must flow to stabilize collapse. Those three pressures shape every reset. This isn't about predicting what will happen next month or next year. It's about understanding why the same outcomes repeat even when the causes look different. This isn't finance. It's architecture. And once you see the structure, another uncomfortable truth becomes impossible to ignore. What if the system can't protect you, even if it wants to? It's comforting to believe the system will step in before things get too bad. That someone somewhere will draw a line and say, enough. But systems don't act on morality, they act on constraints. When debt is too large, when obligations exceed what an economy can produce, choices disappear. There is no option that saves everyone. There are only options that keep the system functioning. And when that moment arrives, protection becomes selective. Savers feel like they're being punished. Workers feel abandoned. Retirees feel betrayed. But from the system's perspective, they aren't being targeted. They're being used. Cash is easy to dilute. Wages are easy to suppress. Pensions are easy to adjust. Assets are not. Governments can promise to protect purchasing power, but they can't print it. Central banks can lower rates, but they can't force real growth. When stability is at risk, the system sacrifices what it can control to preserve what it can't replace. This is why inflation is tolerated. Why bailouts favor institutions. Why austerity always hits the same groups. It's not conspiracy, it's arithmetic. If the system tried to fully protect savers, it would collapse under its own promises. If it tried to honor every obligation at full value, it would fail immediately. So instead, it quietly shifts the burden, spreading loss across time, disguising it as policy. This is the betrayal most people feel, but can't quite explain. They did everything right. They followed the rules. And still, the math turned against them. Promises don't survive arithmetic. And once you accept that, the next realization is unavoidable. The next crisis isn't a surprise waiting to happen. It's already forming. Crises never announce themselves. They don't arrive with countdowns or warnings. They form slowly, quietly, while everything still looks functional on the surface. That's where we are now. Debt levels are higher than they've ever been. Governments are running deficits that would have been unthinkable a generation ago. Interest costs are rising faster than growth. Inflation never fully retreated, it just became familiar. None of this feels like collapse. That's the danger. Before 1929, debt expanded faster than income. Before the 1,970 seconds, money supply expanded faster than productivity. Before 2008, leverage expanded faster than asset values. Before COVID, systems were already fragile, the shutdown just exposed it. Every crisis was visible in the numbers long before it appeared in headlines. Today looks uncomfortably similar. Public debt is no longer something to be repaid, it's something to be managed indefinitely. Inflation is no longer an emergency, it's a policy tool. Political pressure is rising from every direction, demanding relief without sacrifice. These are not random signals. They are pre-collapse conditions, not because anyone is incompetent, not because anyone is evil, but because the system has reached a point where delay is the only remaining strategy. And delay always makes the adjustment sharper. Cries don't arrive suddenly, they mature quietly. And when they finally surface, the question won't be what caused them that will be debated endlessly. The question that will matter is simpler. Where were you positioned when the pressure finally broke? If you're standing in the wrong position when the reset begins, the damage isn't dramatic. It's gradual, and it's permanent. Savers don't wake up to zero overnight. They wake up to money that buys less each year, then less each month, then less each week. The balance looks the same. The life it supports doesn't. Fixed incomes are even more exposed. Pensions, annuities, long-term salaries, all of them are promises locked to a currency that's quietly changing underneath them. Payments arrive on time. They just don't arrive with the same power. Late investors feel the pressure differently. They see prices rising and mistake it for opportunity. They buy near peaks, financed with fragile debt, just as conditions tighten. When the cycle turns, they're trapped owning inflated assets without the cash flow or flexibility to endure the downturn. And the most dangerous position of all is doing nothing. Waiting feels safe. Indecision feels responsible. But in a system that resets through transfer, neutrality doesn't exist. If you're not positioned to absorb the shock, you become the shock absorber. This is why crises feel unfair, because the pain doesn't go to those who cause the instability. It goes to those least able to adjust when the rules change. The system doesn't ask who deserves protection. It only asks who can bear the loss without collapsing the whole structure. Doing nothing is still a position. And it's usually the most expensive one. By the time a reset is obvious, it's already over. That's the cruel timing of every crisis. When headlines finally admit something is wrong, prices have already moved, policies have already shifted, opportunities have already transferred to those who prepared while everyone else was waiting for confirmation. History is unforgiving on this point. In 1929, by the time banks closed, assets were already changing hands. In the 1,970 seconds, by the time inflation was acknowledged, purchasing power was already gone. In 2008, by the time bailouts were announced, the biggest buyers were already buying. In COVID, by the time lockdowns became normal, the money had already been printed. Survival never happens in the middle of the event. It happens before. Positioning isn't about predicting the exact moment of collapse. It's about understanding which positions are punished when systems rebalance and stepping out of them early. Waiting for certainty feels rational, but certainty only arrives after damage. That's why the people who survive resets often look reckless in hindsight. They moved early, they acted without permission, they accepted short-term discomfort to avoid long-term destruction. Meanwhile, everyone else waited for clarity. Clarity never comes in time. This is the paradox that traps most people. They want proof before they act, but proof only exists after the transfer is complete. By the time it's obvious, it's over. Over the last 100 years, history has been patient. It has explained itself slowly, repeatedly, and without ambiguity. Every major reset followed the same arc. Credit expanded beyond reality. Stability turned into fragility. Promises exceeded production. And when the math broke, the system adjusted the only way it could by transferring loss. Wealth was never destroyed randomly. It moved according to position. Those aligned with usefulness survived. Those aligned with inflation benefited. Those aligned with timing adapted. And those aligned with promises paid the price. This isn't a moral judgment. It's not advice dressed up as prophecy. It's a record. A century-long data set written in recessions, inflations, bailouts, and silent erosion. Hope didn't protect anyone. Loyalty didn't protect anyone. Patience didn't protect anyone. Alignment did. The uncomfortable truth is that history has already finished explaining itself. There are no new lessons coming, no new mechanisms waiting to appear. The same forces that reshaped wealth in 1929, in the 1,970 seconds in 2008, and in 2020 are still operating now. They're just quieter. And that's why this moment matters more than it feels like it should. Because the pattern doesn't announce its final phase, it simply continues until the transfer is complete. History has finished explaining itself. All that's left is whether it will be understood in time. The test never ends. It doesn't come once a generation and then disappear. It runs quietly in the background of every system, every policy decision, every promise made about the future. Each crisis is just a checkpoint. Most people experience it backward. They look back after the damage and try to explain what happened. They argue about causes, blame leaders, debate timing, but by then the result is already locked in. Those who understood the pattern didn't need certainty. They didn't need perfect forecasts. They didn't need permission. They understood something simpler, that systems don't protect everyone. That stability is always temporary. And that survival belongs to those who position themselves before the rules change. The next reset won't feel dramatic at first. It won't arrive with sirens or clear labels. It will feel like policy adjustments, higher prices, political noise, and familiar reassurances that things are under control. That's how every test begins, quietly. The people who wait for clarity will get it after the cost has been paid. The people who understand the pattern will already be somewhere else when it happens. This isn't about fear, it's about awareness. The test is ongoing, the pattern is active, and the outcome has never been random. The only real question left isn't whether another reset will come. It's whether you recognize the pattern early enough to move before it did. This channel isn't about hype. It's not about predictions, timelines, or panic. It's about tracking the pattern as it unfolds. History doesn't repeat perfectly, but it rhymes with precision. The same pressures, the same responses, the same transfers, just dressed in modern language. If you want to understand what stage we're in, what signals matter, and how these cycles actually progress in real time, then stay here. Not to be scared, not to be sold hope, but to see clearly, while there's still time to choose your position, understanding always comes before survival. Subscribe if you want to keep tracking the pattern step by step before the reset finishes writing itself.